Right. Welcome. I see people filtering in still. Right. It looks like people are still. We'll wait just another 30 seconds or so before we get started. All right, looks like we have sort of a critical mass. So good afternoon, everyone. Thank you for joining us. My name is Brandon Rose, and I am staff at California Air Resources Board. Today, we are having a roundtable discussion on reducing risk when financing and insuring zero-emission heavy-duty commercial vehicles. A little bit of information just on the work group logistics. Today, the meeting is being recorded, and a copy of the recording will be made available online. Today is really intended to be a conversation with you. And so throughout the discussion, we'll pause for comments. Really want to try to have a free-flowing conversation. Please make sure you raise your hand in the raise hand feature in Zoom, so we know that you want to ask a question or respond to a comment. And then the CARB staff will unmute your line, allow you to speak. And for those of you who may be participating on the phone, I'm not sure if we got that on, you push #2 to raise your hand. And then of course, we always appreciate your patience if we run into any technical glitches today. So let me just run quickly through our agenda. We have about 2 hours scheduled. We'll see, hopefully we have a good conversation. We use a lot of it, but this is how we see just sort of a scratch agenda today. First, we'll talk a little bit about the background. My colleague Olivia Lane will come on and tell us a little bit about Senate Bill 372 and give an overview. We'll run through some initial research, and we'll have Nikki Okuk and Steve Solsky from CalSTART talk about a little bit about that and some of the work we've been doing the last, 6 months or so, maybe 9 months. We'll then run through just a little zero-emission market overview, and my supervisor, Bruce Tudor, will come on and run through that. And then we'll have sort of a group discussion talking about some of the financial products out there for zero-emission commercial vehicles, and then some discussions and challenges. The slides are posted, so you can take a peek at those, and we'll put them. Olivia will put those into the chat if they're not already in there. And then we'll do a little bit of try to get some information about the industry education. Where should we be looking to educate finance and insurance industries on, and some of the best places for us to go, and then just sort of a quick wrap up and next steps. And so, as I said, we do have the agenda and the slides posted if you want to take a look at them. And so I think that's how it will go. And let me go ahead and turn it over to Olivia Lane.
Hi, everyone. My name is Olivia Lane. So I'm just going to give you a quick overview really quick. Senate Bill 372, or SB 372, directed CARB to develop an assistance program to support the adoption of medium and heavy-duty zero-emission vehicles. So this was to include financial support such as incentives, loan programs, and risk reduction strategies, and also non-financial support such as web resources, technical assistance, and training. The bill also directs CARB to provide financing tools that will increase access to capital and reduce exposure to market risks or uncertainties. So even before this bill was developed, CARB offered a suite of programs and resources to assist fleets. And now we are expanding these efforts and focused on assistance for zero-emission technologies with a lot of new programs kicking off this year. So for example, we have a technical assistance program called Cal Fleet Advisor. This is a new program that's going to be launching to the public next month. It's a no-cost program where fleets and owner-operators can get help with creating a plan for their transition to zero-emission technologies. So among other efforts as well, staff has been working over the past year in partnership with CalSTART to research what can be done to reduce risk associated with financing and ensuring zero-emission technology in order to assist this transition. So I'm going to hand it over to Nikki Okuk. She's going to talk about this research and our focus for today.
Thanks so much, Olivia. So a lot of folks on this call have probably been getting emails from myself and my colleague Steve over the last 9 months or so as we dug in to do some research on the challenges and opportunities with financing zero-emission commercial vehicles. There actually, there's a good deal of information in our HVIP program. So this is where we started going through records of HVIP transactions and finding out who had been providing insurance products and financing products for customers currently using HVIP. One big request that we heard from fleets quite often is that they were being denied for insurance and for loans. And they asked if we could share those resources. So there is now a link on the website, and I'll put it into the chat for everyone, where you will find a list of companies who have provided both financing and insurance products in HVIP. And most likely your company is listed there, which is how you ended up getting invited to this work group today. There's also an option on that list for you to add yourself to the list if you see that the contact information is incorrect or out of date. So please update that so folks can find you if they are looking for these products and you folks are already providing them. So the big headline news, which is probably not big news to most of you on this call, is residual value is a big issue for both financing, lending, leasing, and insurance. Folks just don't have enough data. And actually, even looking back through, 10 years of HVIP vouchers and zero-emission vehicle deployments, we also did not find a huge amount of data on residual value. And so we come here to sort of ask for suggestions. We are really interested in hearing what folks think could be done to solve for this problem. It is a fairly new problem in HVIP because traditionally the first movers for zero-emission adoption have been very large fleets. So there were just a large number of vehicle deployments that were being both self-financed and self-insured. It wasn't until smaller fleets began to take interest and zero-emission vehicles began to be deployed with those fleets that we really saw what an impact it was having with being declined both for insurance and for financing. So, we are really seeking to sort of support the market by getting more data about residual value. And then in the meantime, we would really like to potentially develop with your assistance here a product that could sort of bridge the gap, because we believe that the market will sort of solve for this problem in the next 5 to 7 years as the trucks that are hitting the road now come to their natural second life. And we are trying to develop what would hopefully reduce overall risk and allow for lenders to write in a residual value, which they have confidence in and which could be supported by the California Air Resources Board. Another sort of finding from our research was that a lot of folks just didn't know what they didn't know. So I think an easy first step is for us to task ourselves with sort of carrying the message to both the finance, lending, leasing, and insurance industries about the very large zero-emission commercial vehicle market that is developing very quickly here in California, with some quite large transaction numbers and a large volume of vehicles going to be sort of hitting rubber to the road in the next few years here. With that, I am going to turn it over to Bruce to really talk about sort of the market trends and the size of this market that is developing, and why we are looking to make sure that that market has all of the participants in it that we really need to make it a success.
Thank you, Nikki. All right, and there you go. Perfect. Thank you. All right, so I like what you just said, Nikki, about one of the things that we found out, we often find, is that people didn't know what they didn't know. Well, we're going to start telling you what you need to know. We're actually going to talk about education later in this and how to educate the industry. But what we want to bring to you first is, why is this so important? And again, Nikki mentioned that residual value has become, an issue for financiers and for insurers, and we understand that. As we keep hearing, there's no blue book. But why is it really critical? First, just in California alone, these two curves show you what our two main zero emission regulations are going to do. That bottom curve is our advanced clean truck regulation. That is a manufacturer sales requirement rule. And what you will see is that out over, and I'm just going to pick the next not even 20 years, that regulation would be expected to increase the number of zero emission vehicles in California to about 600,000 or even more. Now, add on our advanced clean fleet regulation that we just adopted or approved anyway, about a month ago now. And that is a purchase requirement. It's a requirement on fleets. What you can see is that out at 2040, you're coming close to doubling what the ACT regulation did. So within just the next 10 years, you're looking at these two regulations introducing well over 1 million trucks. And in fact, even in just the next few years, you're talking about 200,000+ trucks in California that will need to move to zero. There are a lot of zero emission vehicles out there. So it's not the problem with being able to find a vehicle. Just like everything, supply chain issues have affected some of the manufacturers. That seems to be leveling out in many instances. There are certainly manufacturers that will basically sell you a vehicle right now. But there are many trucks. You'll see there's over 100+ trucks that are actually in production and available. So as I said, that's not really the issue. Just to mention some other resources for folks out there in the audience that might want to look and learn a little bit about zero emission vehicles if you don't already know about it. And again, we're going to talk about what we know we need to do for education, especially of insurers and lenders a little later. But we know a lot of people don't know a lot about this rule. So going back again to you don't know what you don't know, our zero emission vehicle truck stop web page is designed to give you information, just a little bit of information at this point, on zero emission vehicles, what they are, how they work, where you can get them, all kinds of things like that. And we're just in beginning stages. There's so much information to get out there. One last thing I want to mention on this slide is we have a zero emission loan program pilot that we're working on. And some of you may know we had a zero emission loan program for many, many years that helped people with really poor credit get into, just be able to get into a loan for a new diesel truck. Now we're trying to tailor this program more to zero emission vehicles. And one of the thoughts that we have is that this loan program might in some way be, might be a way to help with this residual value issue and help ease some of the concerns amongst the insurers and the loan. We will be having a lot of discussions, I'm sure, over the coming weeks and months about that. So, any ideas that you have on this whole idea of how we get some residual value, how we assure some residual value, and that could include the loan program, are more than welcome today. All right, I think that's my part. I think I'm turning it back over to Brandon. Thank you, Brandon.
Before you jump off though, I guess one of the questions we hear a lot is, hey, are the vehicles available if I wanted to go buy one of these? Like, is the answer that's yes, and can I get them?
Yeah, the answer is definitely yes. And I encourage anyone to please take a look at the California HVIP catalog. Our vehicle catalog shows the large number of model availability and dealers that can be contacted today to purchase those vehicles.
Perfect. There we go. So we're going to stop for some comments and questions about just sort of this introduction and some of the research. Go ahead, if you want to put up your raised hand feature, we'll take a few questions and then we'll dive into the second part of this, which is more of a discussion. And then Olivia is going to be helping with pulling people off and having them, unmuting them. We did not do a Q&A today. We really do want people to just give their comments verbally. It's a lot easier for us to sort of take notes and keep track, and we don't end up having side discussions in the chat, which often happens as well. So be patient with us as we run through that. Olivia?
Yeah, it does look like we have one hand raised, so I'm gonna allow that person to talk. So Jamie Levin, I've just asked you to unmute yourself so you can go ahead and talk.
Okay, Jamie Levin with the Center for Transportation and the Environment. Steve, we know one another well. I will tell you, we are funded with a considerable subsidies from CARB, CC, and local agencies to deploy the 30 Class 8 fuel cell trucks out of the Port of Oakland. In fact, the first 10 literally just arrived yesterday. And there is no question that insurance and the matter of residual value are big stumbling blocks in trying to roll this out. And you're not going to get, the insurance industry is all based on risk. And they don't want to take any more risks, or they want to make sure if they take too much risk and they have too many payouts, they're not going to sustain their own business. So they're very cautious, understandably. But the only way you get at the question of what is the residual value and drive insurance costs down to a more reasonable level is if you have empirical data on long-term value and operations of the vehicles, and we're not there yet. I will tell you that we go to many trucker forums, and they're all excited about the prospects of fuel cell trucks. There's room for both battery and fuel cell in this market, but many of them are very excited about fuel cells, but they have to be able to afford it. And the cost of financing it without capital subsidies, or call them incentives, to drive down that initial cost without understanding what is the residual value after 8 to 13 years. We don't know that. We're not even sure with the expected success of this fleet of 30 trucks that have millions of miles on them in Europe and many tested miles here in the United States. What will be the value in our case, it's a 6-year program with a 6-year warranty. What will be the value at that time? So to me, kind of to get to it, and I throw out ideas of suggestion, a trucker is not subsidized, right? It's all about their total cost of ownership, and they have to afford the service that they're competing to sell to other truckers who are not adopting this advanced technology. So they need help with writing down the capital costs so that they can afford to lease or buy their equipment. And secondly, they need some assistance with insurance, right? They can't go without. We've been able to get liability insurance, but getting collision insurance if the trucks were destroyed in an accident, given the value of those vehicles, almost impossible. We're still working at trying to solve that problem with the fleet operator. So I'm thinking one thing that the state should look into, and maybe have discussions with the state insurance commissioner about pooling, some sort of statewide pooling program that would help advance these zero-emission vehicles before we get to the volumes, which gives the insurance industry some understanding of what's there. And then one last comment. I know I've been going on here, so I don't want to totally dominate, but I think the other key issue is affordability. Many of the small fleet operators, independent truckers, buy second and third hand trucks. So they're paying, a diesel tractor for day cab drayage is $150,000 for a new truck. They're buying secondhand around $75,000 or thereabouts. Now until you expand the zero-emission supply to create a marketable secondhand tertiary market, they're not going to be able to afford it, even with your loan programs. So my point here is, I think there's, and I've made this point to CARB in previous discussions and meetings, we have to look at deploying large numbers of these zero-emission vehicles, working with the larger fleet operators. I know there's certain caps on those larger operators, but they are in the best position to afford to take on this technology. And even for them, it's difficult. So only way it's going to filter down for the smaller fleet operators. And I've had many discussions with those small fleet operators. I'll stop at this point, but those are issues we're dealing with now, and I wanted to make sure they're heard.
Thanks, Jamie. Maybe I think we should respond and talk a little bit about the innovative small e-fleet project that several of us on the panels here are working on currently. And then we do have a bullet point in one of a slide or two on group pooling. And so I think we should dive into some of these other issues when we hit those bullet points as we go along, if that's okay. And I only see one other hand up. But Nikki, could you maybe tell us a little bit about the ISEF program within HFIP?
Yeah, sure. Thank you so much, Jamie. I really appreciated all of your comments, and I hear very similar things as we work with small fleets. Last year, we began this program, the Innovative Small Fleet Set Aside, which put $25 million towards additional incentives for fleets of less than 20, specifically in trucking, so not intended for small bus fleets or public fleets. And we were very excited to have that program oversubscribed really quickly. It got us to double HVIP vouchers for those small fleets, which in many cases got them very close to a diesel cost parity. And so we're really excited by the interest that we've had in that program. CARB has allocated more funding to that program this year. So that will be opening in August with $36 million available. We also included in this sort of pilot the ability for folks to do more flexible, innovative, and interesting financing options, where we have providers who can offer sort of packages like truck as a service. So that's where you would find some of the sort of like more interesting leaseback models, or again, like all-in service agreements that can include things like chargers or bundled insurance. So we have seen some really interesting, innovative solutions, and we've seen folks in the market certainly creating new products to meet this need. However, I think we can all agree with some of the things that you said, right? Is getting to scale and getting deployments to scale is really going to require us getting all of the sort of market participants in the room and putting pen to paper on how to scale electric vehicle transformation. Was there anything else you'd like me to add about the ISEF program, Brandon?
No, I think that's a good overview. I mean, we've been crunching the numbers, and it's bringing down the actual out-of-pocket cost to be fairly close to what a used vehicle is of these drayage operators. Their trucks, or as you were saying, 75. I've always said 40 to 70,000 for their older trucks. I'm a longtime truck and bus staff here at CARB. I helped write the truck and bus rule in 2007 and 8. So I've talked to a lot of truck drivers over the years. Olivia, do we have
Yes.
another one?
Yeah, we do have a couple more hands raised, and I just want to remind people to state your name and affiliation before asking your question or making a comment. So next I have Joshua Miller. I've unmuted your mic.
Okay, hello, can you hear me?
Yes.
Yes, my name is Joshua Miller. I'm the VP for Axion Opportunity Fund, and we are a California-based nation-leading community development financial institution. We're a nonprofit, and we provide access to capital and coaching and technical assistance to underserved entrepreneurs. A significant amount of the capital that we provide I mean, we've deployed over $800 million nationwide, almost 500 million in California alone. A good portion of that is for trucking loans, and we have been a big user of the CalCap for trucking program. And we recognize, I think it's set to expire in 2024 with about $28 million left. And so I had a few questions related to that. The number one question is related to, was there going to be additional funding allocated to that original agreement between the Treasurer's Office and CARB? And given with the new Zero Emissions program, is there going to be something similar in its place if this program was to go away, to ensure that we're able to continue to help people finance their trucks?
It's a good question. I have Eric Patton on here. He has been working on the CalCap loan program, and then the new Zero Emission loan program we're working on. We're going to start a transition, so I believe I'll be leading that going forward. Eric, do you want to say a few words about what we're thinking? This is not a workshop on the new loan programs, but we do want to cover it just a little bit.
Yeah, well, we are, the program right now, it's still enrolling loans. It's going to be the existing funding that we have in the program right now. That's going to be used to enroll loans. We're going to use the existing funding that's in the program right now to enroll loans this year until it's used up pretty much.
Okay.
Perfect. We definitely have a lot of work. We want to get, and Bruce mentioned this, we want to get the Zero Emission pilot program off the ground as soon as possible, definitely by the end of the year. And so we'll have a series of workshops. We've been having individual discussions, but we'll continue to work on that as well. And see, and then Bruce mentioned this, we're thinking about how can we maybe build in some residual value second life guarantees into the loan program. And we'd certainly, as we go on a little bit more today, we're certainly happy to hear your thoughts and ideas on what that might look like as a potential option for sort of expanding what we're already doing.
Okay, thank you.
I do want to move on to the next couple of slides. Let's go ahead and do that, and then we'll jump back over to the comments video.
Okay, sounds good.
Because I think some of that's going to tee up the discussion a little bit more. Give me 1 second.
So if your hand's raised, just keep it raised, and we'll get to you at the next break.
I only see 2 up right now, so not too bad. Okay, so just a couple of, we're going to run through some bullet points on my thought process that we would sort of stop and have a discussion about these various topics and do a little bit deeper dive on each one. Trying to let people have the opportunity to respond to what they're hearing, because I know a lot of time when we're in public workshops, people will raise their hand and you'll get 20 hands raised, and then by the time you come up, it will have been 10 or 20 minutes since what you wanted to respond to came up. So I really want to try to run this a little bit more like it would actually be if we were in a room together. We'll see how it goes though. So let's just talk about a couple of these first bullet points. One, who has financial or insurance products for zero emission commercial vehicles? Nikki, you talked a little bit about doing our deep dive into the HVIP data. Nikki, would you maybe talk about that a little bit?
Yeah, as I've mentioned, we found within HVIP, first of all, that most of the larger fleets were both self-financing and self-insuring. So we had to sort of take a step back and go a little bit further down the list. And in that list that was posted into the chat, you will see sort of a large variety. We have everyone from your more traditional sort of banks, big banks that you would think of, down to some sort of smaller niche and specialty finance and lending. I will also say that from the residual value data that I was able to extract, it was also all over the map. We had folks who were writing residual value for trucks down to zero. We'd focus around the sort of 10%, 15% mark. Others coming in at around 30%. These are mostly five-year loan products. None of which is really very close to, I think, what a diesel comparable residual value would be, which is like closer to 40 or 50% after 5 years. So this is the problem. This is the gap we're trying to bridge. Curious to hear what others on the call might think about what I saw or what you guys might be seeing in your work.
Perfect, thank you. I'm just busy texting Bruce Tutors. His internet has blown up on him, so he may be on the phone. That's great timing. Let's start there. And I know I was having a discussion with the leasing company at the ACT Expo. You know, hey, how do we make, if we give a 40% residual on a diesel after a long-term lease, and we're doing 15% on zero emission, how do you bridge that gap? Was one of their question marks. But let's take a couple more hands. Olivia, who do we have next?
All right, so our next hand up is Rochelle Pletcher. I've unmuted your mic. Go ahead.
Great. Hi, everybody. Sorry. Can you hear me?
Yes.
Yeah, okay, good. Wanted to double check the audio was working. So my question was actually back on the previous slide, which was just wanting to understand that transition in the programs, right, from the traditional diesel loan assistance program to the zero emission. I just wanted to clarify what I heard there, right? Obviously, there's money in that existing fund. Is the vision in the near term to end that program and essentially switch fully to all the funding going towards zero emission vehicles? Because it feels like there's still a ways to go. As you said, right, zero emission vehicles are becoming more available, but if you compare that, right, still to the large preponderance of what's being produced out in the marketplace, it is definitely still the minority, right? And we still have a lot of, especially in the owner operator segment, right, the very small fleets, folks who are running, right, older diesel engines, and there is still an opportunity, I think, for them to be able to participate in the program and make efforts forward, right, to get some of those really, really old non-fuel efficient trucks off the road.
Oops, my computer. Oh, sorry, that's my mouse, and it just changed your slides. Hang on a second. I have a response for you though. I'd say this: the CalCap program really has been designed to assist with compliance with the various vehicle regulations. And now that the truck and bus rule is pretty much done as of January 1st, 2023, the regulatory driver sort of expired what that program served to exist. And then we have these new pieces of legislation that are pushing us to get into the zero emission market and the new rules. So sort of looking forward, we'll certainly the program will exist in so much as it continue to guarantee the loans that have been made. But I think the idea is a transition, and then what that transition looks like, I think, is still something that we're working on and will be decided. Some companies have sizable amounts in their accounts, and I think that's open for discussion, what we do with that funding and how things will actually transition to a new program. Eric, do you want to add anything to that?
Yeah, well, just not too much. Just, we last had the funding was allocated for 22-23 last year to the truck loan assistance program, and so this year the loans will keep them rolling loans from that funding that's already in that program that was allocated last year until essentially till it's exhausted this year. So
hopefully that helps a little bit.
Yep, thank you.
All right, so I'm gonna move on to our next hand. Peter Tawil, sorry if I mispronounced that. Go ahead and talk. I've unmuted your mic.
Great, thank you. Actually, the question is regarding ISEF. Which I think is a great fund. It's best way to get somebody in a truck because of the higher amounts, especially the smaller fleet. So it's really it's a great program. I just want to mention that. But what is interesting is it's made for the smaller fleets who are the least capable of getting loans and insurance. So it's like almost at polar opposites. And it is actually pretty apt to discuss it because I bumped into a customer that we were trying to get into a truck about 9 months ago. I bumped into him at Draytech, introduced him to Nikki actually, and the guy has 6 trucks. So he's a great. He could be anybody, right? He's very similar to the small guys. Under 10 is, let's just say, a guy like him. And it was through Carl Moyer. It didn't go through. But he told me, and he says, Peter, listen, we really want to be a first mover. We want to do good and do green, but we're too small and we can't be the guinea pigs. We can't be the first movers. We just can't afford it. He goes, I ended up having to buy a diesel truck, a used diesel truck, 2 or 3 years old. That's what's going in the registry for next year. I had to cut down on some of the my drivers. AB5 passed, loads are down. I just can't afford to do it. And I go, I totally understand. So I don't know that maybe the guys under 10 are going to be ideal part of the pie right now. He's gonna wait. They're gonna find the cheapest way to do it. We all know drayage is usually some of the lower revenue per mile versus the other categories. So then we have that little 11 through 20 in ISEF that's left. And I think Nikki, we kind of said, a sweet spot could be 0 to 50 instead of 0 to 20. With guys that are actually or companies that are looking to get into this. Is it possible that we grow ISEF into a slightly larger number instead of under 20, that maybe it's under 40 or 50, that we know the guys under 10 might be sitting out on this one because of finances, and they can, for example, the port, there are other ways to get into the port, legally for the registry. So is that possible? Is that an answer? I mean, it's an easier answer than having to go through a new fund or a new program. Question mark?
It's the same folks. We're still without the same folks who are doing work on ISEF. We workshopped ISEF, remember, Innovative Small E-Fleet, part of the HFIP program. And we did workshop it last month and sort of laid out our plans. We were planning on doing this 20 or fewer vehicles into the August timeframe. I think in this funding plan process, that's going to start the first week of June. I'll talk about that at the end a little bit more, and run through a sort of November board hearing. I think there's room to have that discussion what ISEF continues to look like. And so I think I would encourage you to participate in that. Yeah, Olivia?
Yeah, that was what I was going to say as well, Brandon. Like that would be something that we'll obviously note that comment now, but that would be a topic to discuss as we do this funding plan process, thinking about changes for the future. So yeah, good comment. Thank you.
But Peter,
Can you guys hear me?
Bruce,
Sorry, I'm kind of back. I'm on my phone. I do apologize, everybody. Of course, my internet would die. And one thing I just wanted to chime in really quickly on the ISEF issue. That is kind of the I in ISEF is innovation. The funding is fairly low. I completely appreciate the commenter. Can we make that funding available to maybe some larger fleets? But I think at this point, and that is what we're trying to do, is find innovative solutions, not just a straight purchase for these smaller fleets. And again, as I mentioned, it's about 33 million out of a much larger pot. Certainly the kind of thing we could take back. But I think that's a really good direction for ISEF, actually. And we've had a lot of folks kind of taking advantage of it. So that's where we are right now. Thank you.
And Peter, I missed who you were representing.
Oh, I'm with Hyzon Motors. So we do fuel cell, which is even a little more challenging because we're a little bit newer technology and more expensive. So it gets a little bit more difficult. But I understand the innovative part. But we're talking to everybody. I bridged a call last week with Crossroads, and we're talking about from a finance perspective, you know, they're worried about the risk. I totally understand it, you know, and small companies. One of the big OEMs, I remember saying, one of my buddies over at the other OEMs, I said, hey, I heard you guys doing financing. And he goes, yeah, for the bigger fleets, not for the smaller guys. So like, again, the smaller guys is going to be it's a different animal. Yeah, innovative, but if I could find somebody to put all the pieces together, I would, but we're not. So we're going to leave these guys out. And then, you know,
on the next slide, they do have a bullet point on like warranties. And so please chime back in and we can talk about what are some other strategies and what do the warranty provisions look like and how does that give assurance to financiers or insurers? I think there's a discussion.
Well, I will say this about the warranty. I did hear warranties are great, but, and this is a serious thing because I have an electric car. I think some people have have electric cars that are small, you know, they got 2 years ago and might be a little outdated today. It goes so quickly, nobody's even knows if the battery is valuable or whatever. It's like in 2 or 3 years, who knows what Elon Musk is going to invent and make everything obsolete, you know? So like, we're in such an uncharted world. We don't know, you know?
Perfect. Okay, let's keep moving, but we'll chat with you some more a little bit later.
Thank you, Peter. So the next hand raise I have is, I'm sorry if I pronounce this wrong, Urvi Nagrani.
Yeah, thanks for calling on me. Urvi Nagrani, founder of Unflappy, a small company that works on doing site assessments for fleets. And the thing that I kind of want to bring to your attention is when you ask the question, what is an acceptable risk? The answers are going to look really different when you are trying to define what is the primary mission of either the fleet or business. And while, for example, we have compliance rules where fleets are going to have to move into lower emission vehicles, the reality is if you go to those fleets and you ask, what do you want? They don't want a new truck. They don't want a new truck. They don't want an insurance product for a new truck. And so they're not, you know, clamoring away saying, if you give me this product, I will buy. It's much more the early adopters are the ones who are willing to already come to the table, bring their own financiers, self-insure. All of the solutions that are sort of easily implementable are being done by the people who are comfortable being on the bleeding edge or on the cutting edge. But if you want mass adoption, you need a much more user-friendly approach that deals with people who didn't want to do it at all. Like, you know, Palm Pilot and Microsoft never reached the smartphone market that was consumer friendly the way Apple did. We're going to see that same sort of thing of what a consumer friendly low emission vehicle looks like over time. But the idea of, okay, let's just increase the warranty is, I think, actually misguided because right now, for example, if you're a manufacturer and you buy a battery pack, you're getting a battery pack that is warranted in number of cycles. So let's say it's 1,000 cycles, and let's say you're doing a cycle a day. Well, cool. You've got about 3 years worth that the battery manufacturer who knows the cells at a technical level will warranty it. If CARB says, guess what, we're going to make a requirement, and now you have to warranty it for 8 years instead of 3 years. Well, now you've got a scenario where your battery pack warranty isn't going as long as what you're requiring the consumer to get. So the financial risk is already being transferred to the OEM, and you're saying, okay, I've got 5 years of risk on an unknown product, and maybe this product was invented 2 years ago. There is no one from the designer of the battery, the OEM, the insurance company, who can in good conscience say, I actually know what that data is. No one does. Anyone who says they do is either using a computer model, which is speculative, or lying. And both of those cases are not actually going to lead to knowledge. However, what we do know is if we don't stop emissions, climate change continues, and that is an existential risk for all of us. And so I think part of the question needs to be, how do we move forward despite the risk? Because if we say we need to just make changing EVs risk-free, that will never happen. You know, increased fire seasons are going to change our weather usage. You know, new net metering rates are going to change your energy forecasts. You think about every time a utility does an updated commercial rate plan, you can't make a TCO calculation a decade out for a plan that, you know, your utility rate might change in 2 years. So it's kind of ridiculous to assume that we will get to an acceptable risk for a customer who doesn't want change. The more important thing is, how do we create a tolerable risk where under the regulations, we can force the actions that lead to clean air? Because I think that is a different question than what is acceptable to the customer. what is acceptable to the community isn't really part of this discussion, but needs to be. Because otherwise, the risk of a diesel engine is my kid has asthma because you live in a disadvantaged community near a highway, and my financial impact was never calculated here. And so I think if, for example, the insurance commissioner is brought in to say, okay, what are the baseline requirements we're going to make? Similar to, Obamacare said we have to cover preventative care. Suddenly insurance companies who didn't want to do that started to do that. I think if we're going to do that, we need to say, okay, let's have CARB work with the insurance commissioner and say, what was an acceptable level of risk that, the insurance commissioner could be the backstop of, similar to the way that the Small Business Administration has SBA backed loans, because there's a public policy objective we want to achieve, where we socially will absorb some of that risk. I think that needs to be part of the question here, because if we just wait for the private sector to do the thing it never wanted to do, everyone's going to drag their feet and then say, look, it wasn't doable. And then they're going to ask for a rule rollback. Like, we've seen that playbook before. We don't need to see it again.
Great. We do have representatives from the insurance commissioner here. So we need to chat. One of the things we're thinking about in terms of risk was more from the financial perspective of a bank or insurance company. And in our conversations, and Nikki, do you want to chat a little bit, or do you want me to continue?
Yeah, I mean, I think that Irvi is like right on track, right? She's thinking all of the things that we're thinking as well, which is we're talking to, say, lenders who are saying they would only underwrite loans for the major OEMs. They're not willing to finance any of the born EV OEM startups that are out there. And, we're coming from the other end, right? Brennan, Olivia, CalStart, and CARB are thinking, well, we're not going to pick winners and losers in this industry. We know that all of these vehicles need to have, a reasonable financing option available to them. And we know that the lenders won't accept that risk, but the folks that are on this call are the folks that can develop products to absorb that risk and bridge the gap. So that's sort of the goal of all of this conversation, is saying we have a place that we have to get to, and the data does not exist to allow the market to make that decision in an informed way right now. We have to design the backstop that will allow the market to move. Sorry, back to you, Brandon.
Yes, I would ask, maybe if
Brandon, can I just real quickly
Yeah.
just address something? Irvi, I really appreciate what you said about some of these fleets can't afford to be first leaders, but some of them are almost being forced to, especially because we undertook this because we were hearing a lot of the issues with insurance and finance were coming from the drayage fleets at the ports, and they were the ones who really are getting the pressure to move to zero emission more than traditional delivery fleets or anyone else. So they do have some outside of financial pressures that they're going to have to respond to. So that was one of the reasons that we got involved in finding out what exactly were the issues that they were facing and which subset of users were being hit the most in this area.
Brandon, this is Bruce, and I just want to put like a fine point too on what you said. That is really what today is about. Is, Eric, you brought up that we can't just let the private market figure this out. That somehow we have to spur that and move that along, and that's exactly what we're trying to figure out: is how do we provide some assurances to industry in this case being insurers, being lenders, somehow that we as CARB or others can help move this along to a point where we don't need to anymore, to a point where, and I think was Nikki said earlier, 5 years from now, there's going to be a residual value. We're going to know what the secondary market has brought. So I do hope that everyone keeps that in mind today. Those are the kind of solutions we're really looking for. What can we do? Is that in some kind of a financing program? Is that in some kind of an insurance program? Just what is it?
I would be curious if we have anybody from maybe an opportunity fund or like a public benefit bank. Is there a different perspective that they might have over like a strictly for-profit organization? It's something I'm a little bit, if anybody in the audience, anybody on the call has any thoughts on that, I'd be really keen to hear what you have to say.
In the meantime, you ready for the next hand, Brandon?
Yeah, let's hear one more, and then I
Okay.
think yeah, let's hear.
Actually, before we move on, Irvi, what was your affiliation? I'm not sure if you said it, but I didn't catch it.
It was
Unflappy. It's a
Unflappy.
small startup.
Okay, great, thank you.
UNFLAPPY.
Great. All right, so we'll move on to our next hand. Vanessa Morlon, I have unmuted your mic.
Vanessa, are you there? You're muted, you're unmuted, we're working on it.
It says she's unmuted, but we don't hear you, Vanessa. We'll come back to you. So I will move on to Howard Schiebler. I've unmuted your mic.
Great, can you hear me?
Yes.
Hi, I think we're talking about with respect to.
Oh, sorry, Howard. Do you mind giving us your affiliation?
Hi, I'm the president of Crossroads. We're a large CalCap participant, truck financier in Southern California.
Awesome, thank you so much.
And we've done a fair amount in the CalCap world, which I think should be strongly leveraged here, as we've talked about quite a lot, to bridge both some of the credit and residual risk associated with this. And I think those ideas are brewing to try and fuel that as much as possible. I do think there's two things to consider from, I guess, from a customer perspective, a borrower perspective is, you know, when we talk about residual value, what's the useful life of the asset going to be, and over what period of time can I amortize that? A port operator typically can amortize the truck over a longer period of time, assuming that the technology doesn't change dramatically and make their truck obsolete, which could happen. But that amortization of cost, if we look at, say, a 10-year period of time, there's the concern for us lenders about, well, what happens along the way with this technology risk. But there's a more fundamental issue. Even if you amortize it 10 or 12 years, today the cost differential between zero emission options and non-zero emission is so substantial that we still haven't fully bridged the gap. It's very hard to make the economics work. And so if I was a small to mid-size operator, I actually couldn't make a living with the truck today because I couldn't generate enough revenue to offset that cost difference. And I do think we have to figure out a formula collectively of what is that, how can we stretch that amortization without being stupid about it, because you don't want the amortization to be longer than will be the real useful life of the asset. But what are the ways that we can get the cost down to a level that will be commercially viable? Because that operator is going to be competing for a long time with other diesel trucks or natural gas trucks. And that transition, if we're going to get any volume of impact, we're going to have to figure out really how to get that total cost of ownership equation. And I haven't seen anybody that's shown me that equation that can work. And the other thing I just wanted to mention is I still think, even if we overcome that, still the very long pole, if you will, in the tent is charging availability. And right now it's a problem just in terms of the lag of time. the permitting and obstacles to actually being able to get it in place. And I almost feel like that has to be worked on and discussed separately because it's so big. Thank you.
Those are great comments. We do have a representative from the California Energy Commission on, who the Energy Commission really focuses on infrastructure. The two agencies, the two sister agencies, sort of split, where CARB, the Air Resources Board, focuses on vehicles, and then the CEC focuses more on the infrastructure side of things. So they have the Cal EVIP 2.0 and the Energize program that are both operating to help with charging stations. But I think it's an excellent point that we're hearing. And I know when I was doing my risk reduction research, there wasn't a whole lot on the heavy side, but there was definitely more on the light duty side. And when the Tesla Model 3 came out, and all of a sudden it went from offering pretty much doubled through the available range and the price, that market price of, I want to say, $40,000 to $70,000. The residuals on the older vehicles, like the older Nissan Leafs or the Volts, dropped significantly. So the risk definitely is there if you sort of look at some of the other sectors. But it's also challenging. Part of me wonders, is if the Volvo, the VNR has a 275-mile range, that should be sufficient to cover a lot of different types of work as well. It's not going to really cover you over the road necessarily if you need 500, but it's not like, hey, there's a new truck out that goes 1,000. This one that does 300 loses all of its value. So there's definitely that sort of fine delineation. But you're also totally correct. You don't have to over amortize, and you don't want to go past the useful life. We did do a fair bit of work at CARB on cost analysis for the ACF role development, and we were showing the total cost of ownership was pretty close to the same, with a number of assumptions in there, of course, but it really was the big hurdle of getting that capital and the capitalized costs, and then the ongoing costs were lower. And of course, we still ran into the super high insurance costs, which is what we're talking about today. So those are sort of my quick thoughts. Let me finish these couple of data points, a couple of bullets on this slide, and then we'll move to the next one, which is that last sort of core slide. Are there any data sensitivity concerns that we as an agency should be aware of? Any sort of black boxes, secret sauce that you consider confidential business information? Are there any financial roadblocks that you were seeing? I think we've heard between the small and the large operators. And then we've alluded to this, is what can help quickly. We know the market will figure it out. There's a lot of smart people. But is there something, what are the sort of short-term actions that we as an agency, if we want to put some funding into a couple of projects and really try to have a menu of options, what might that look like as well? But let me go ahead and dump one more slide. There we go.
Do you mind if we go back to Vanessa and see if she can?
Yeah.
Okay, let's see. Vanessa, I unmuted your mic. Do you still have a comment or question?
Not Vanessa's technology day, it looks like.
All right, okay, we'll go ahead and so Vanessa, if you do want to speak again, just raise your hand again. All right, we can move on now, Brandon, thanks.
Perfect. So yeah, those are sort of thoughts. A few more discussion sort of examples. We really were curious about residual values, any kind of a blue book. We've heard the term black book. We're curious about, like, where do we get that data from? One of our takeaways, and Nikki, I think, mentioned this, is looking at being a little more deliberate with our HVIP data, and trying to say mine that a little more and make sure we're capturing it for the vehicles that are coming through the program. But are there other sources what we should be looking for that we can sort of help highlight? And then where can we post this data? What's useful for the industry to even sort of build a residual value database? Any thoughts on that. Nope, I'm not seeing any hands.
Yeah, we do have some hands starting to raise. So just a reminder, when I unmute your mic, just say your name and your affiliation. Okay, so we're gonna start with Jamie Levin. I've unmuted your mic.
Yeah, have you thought about organizing a kind of a team of insurance brokers and insurance agents to talk about what are their critical needs in order to help advance these zero emission vehicles? I just think it's, I said it before, they don't want to assume any more risk than they have to, but they don't know enough. And we don't know enough. I will tell you this, our project, which Carbon CC had funded, it's going to have a lot of information here coming up very shortly. We're about to deploy these vehicles. The challenge is to get the finances right. One of the previous speakers spoke about the affordability. It comes down to the fleet operator to total cost of ownership. And I would argue if we can solve how to underwrite the high capital costs until volumes in the thousands of trucks drive down price, even if we gave these trucks away, operationally, there are significant operational costs. Insurance is clearly one of them. In the case of hydrogen, fuel price is significant. We hope to see some progress with the hydrogen hub program that the state has applied for funding. But I think on the insurance pooling, it really needs a concerted effort to bring as many insurance spokespeople together, roundtable discussions just with the insurance people and the OEMs, who are the ones that are going to step forward to make these vehicles and to address these questions of residual value.
Perfect. I think I saw Mike Peterson with the Department of Insurance is here. Hi, Mike.
Hey, Brandon, thanks so much. Appreciate it. I just, since we're on the topic of insurance, I figured I'd just jump in real quick with a couple brief.
Can you just give, what's your role there?
I'm the Deputy Commissioner on Climate and Sustainability at the Department of Insurance. Sorry about that. Insurance Commissioner Ricardo Lara is our Insurance Commissioner, and I'm one of his deputies focused on climate change and sustainability. And I just had three quick things to share. One is that this is an area where, as an insurance regulator, we do see when new technologies come up, this challenge is pretty similar with each new technology. We just are in a phase where the number of new trucks that we project and want to have in the state is accelerating very quickly, and it's just unclear, how insurance is going to match that effort. That doesn't mean it won't, but it just is unclear. And so, at least at the department, we've approached this through looking at all different types of technologies and how insurance can be sort of an accelerator of those technologies and not a barrier to them. And so the second thing I just want to share is that for this particular case, we don't have the capability of selling insurance. That's for the insurance market to do, but we do have the capability of collecting data. And so we are trying to, through some sponsored legislation this year, focus our data collections on information on coverage limits, pricing, risk and risk reduction that could be very helpful over the next several years as fleets do try to adopt these new technologies. And so that isn't a specific answer for risk pooling today, but it is going to lay the groundwork for what's going to help with insurance as we move forward, because as new technologies progress, there are going to be, they're new. And so there isn't that actuarial history that most insurers rely on to write that coverage. So anyway, and finally, just I know that this is meeting, I don't want to take too much time, but there's a lot of stakeholders at this meeting that are interested in insurance. The Department of Insurance has this climate sustainability branch. We have a sustainable insurance roadmap that we're working on implementing, and this is a major focus point of that. So I'm happy if you contact our office afterwards, I'm happy to follow up. So thanks, Brandon, appreciate it. And if I can answer any questions, I'm happy to be here.
Perfect, thank you. Thank you for that. Jamie, is your hand?
I wanted to say to Michael, we would very much like to convene with you as to the challenges, the real world challenges we're dealing with, just to get 30 Class 8 fuel cell trucks with a 450-mile range, pulling 82,000 pounds. We would like to talk to you about what the challenges have been to get insurance coverage on property insurance. That's been the real bugaboo. We've been able to get liability insurance, but property insurance for these very expensive trucks, I think it'd be of value if we could go to whomever we should reach out to and have that conversation.
I'll make sure to look you up after this roundtable. But yeah, I'd love to convene and discuss further. And these are the types of challenges that we try to understand and identify and address. So thanks very much.
We definitely have Jamie's email address around here. I read through a lot of our ACF comments. We're not working on the rulemaking last month. So I mean, I guess I brought a little more. We have 100 and some odd people on the call. Is anybody have specific background in doing residual values and that type of work that might have some insight to share with us? We'll give it a few seconds.
Looks like we do have a hand raised. I'm gonna unmute David Clamage. Just let us know your affiliation and let me know if I mispronounced your name.
You were reasonably close. My name is David Clamage. I'm with Generate Capital, and I have been in the equipment leasing and finance business since 1976. Lease transactions are really only comprised of three things: lease payments that the customer makes, tax benefits and other incentives, and residuals. And the residual calculation, to the comment that Mr. Peterson made, is actuarial. We look at large samples of data. We know we're going to get it wrong in many cases, particularly in new asset classes like electric vehicles. And by default, lessors are gamblers. We are making loans to customers. We expect that they will make their payments in a timely manner, and we make mistakes in that regard as well. So we're looking at analogs in the ICE sector. There's lots of data that's available from a variety of sources that has hundreds of thousands of ICE vehicles and precious few in the EV sector, very, very few resales, repossessions, or remarketings, and even fewer in second life battery deployments that a person commented about earlier about cycle times. So in my opinion, and I've had this conversation with Nikki and others, I believe where you can prudently use state dollars to help support residual values, you address two calculations at the same time. One is helping the smaller fleet operator who may be credit challenged. He or she may not have the best credit score, but a newer company with routes that are profitable or could be profitable. Where you support the residual value, you are at the same time supporting the collateral value. So collateral and credit go hand in hand. But I think another comment that I'll close with is the end user of these truck fleets, the businessmen and women who are buying the services of trucks that are moving goods throughout our country, need to also understand that in order to green our country, which is truly existential, as another commenter made earlier, it's going to cost more, which means at the end of the day, all of us on this call who are buying those goods and services need to be prepared more for the greening and sustainability of our country. Thank you.
Thank you, David. Did anyone want to respond to that, or should I move on to our next raised hand.
No, I appreciate the comments and the feedback, that's for sure.
All right, so thank you, David. Okay, the next hand I see raised is David Sargent. I've unmuted your mic.
Hi there, can you hear me okay?
Yes.
Hi, my name is Dave Sargent. I'm a Vice President at JD Power. In terms of residual values, I will confess I am not our expert on residual values, but JD Power does a lot of work in the residual value business, primarily in the retail market and obviously to date, primarily for ICE vehicles, but we are certainly looking in depth at the EV market. We have two main parts to our business. One is we own a company called ALG that helps to set residual values in the retail market for the OEMs and the finance companies. And then secondly, we also own JD Power Used Car Guide, which helps provides a metric for used vehicles that are actually going through the remarketing process. So helps dealers in particular determine the right price to buy a secondhand vehicle at. So what I'll do is I will talk to our experts probably tomorrow now and see what activities we have available or planned in the commercial market, but also in the EV space, to see if we can help in this area, because obviously it's a key need. As Brandon also knows, we're also working in the area of battery health, again, largely in the retail market, but certainly a lot of the expertise we have there is applicable to the commercial market too, and so we can talk about that offline. But just to say that you said who on the call has expertise in residual values. Well, we do, although maybe not exactly in this area, but a lot of it could be applicable, and we're happy to help in any way we can. And I'll get back to you when I find out more from my JD Power colleagues.
Perfect, thank you for that. And I know I've said this so I got my start at the California Energy Commission in the solar and wind program, and then transitioned over to CARB doing the trucks. And it's been very interesting the last 5 years or so to watch the two industries come together. But the technology is new, right? Battery electric and hydrogen fuel cell trucks. And so we don't have answers to a lot of these things because it is new. Nobody has expertise in it, but it's good to have partners and people participating as we work through some of these issues and try to get some better answers. So thank you for being here and chiming in.
Sure.
Olivia, do we have another couple hands?
Yeah, we have a few, but I also see David Clamage. Your hand is still raised. Did you have something to add?
I think it's still up. There we go.
Okay, cool. All right, so our next hand is Niles Walther. Sorry if I mispronounced that. I've unmuted your mic.
Can you hear me okay?
Yep.
Very good. Okay. Wanted to respond to the previous two comments. So my name is Niels Walter. I am responsible for sales operations at Nikola Corporation. Nikola is producing zero-emission battery electric and fuel cell electric Class 8 trucks based in Arizona. And as we launched our products into the market, we found ourselves exactly in that position, that we identified finance partners that we worked with in order to provide financing products and lease offers for fleets, and quickly realized that exactly what David Clamage, I think it was, mentioned previously, there's a bet to be made here. We don't have the data pools that we normally would have and that we traditionally rely on in the trucking industry. We want to determine residual values. And so we spent a lot of time with a couple of different finance partners we're working with to just run them through our view of the world, not to tell them that we have the answers, because the truth is we don't. But we know a lot about our trucks. We know a lot about the testing that we've gone through, the validation miles that we've accumulated prior to launching the vehicles into the market, all the data that we're collecting now that the vehicles are in customer hands, in our validation miles as they continue to be tested as we go along. And all that to be said, I think it's a really interesting opportunity for different parties to come together. And I want to invite people to reach out to us. We'd be more than happy to sit down and review some of the things that we've been able to share with our partners in our understanding of the trucks, the anticipated life cycle of the vehicle, of battery degradation, how to think about battery degradation. State of health is a very different question if we are talking to consumer customers that are driving their personal Tesla and put that in the garage and may or may not be concerned about the Sunday joyride to not go as far as it used to at the beginning of the vehicle's life, or what that means for commercial customers that actually need to fulfill a job with that activity, with that truck. So I think we learned a lot in the past year or so in working with our finance partners that we already have on board. And whether it's JB Power, David Sargent, more than happy to connect. I'd be very interested in starting those conversations, or anyone else that is interested in starting those conversations. I think there's a lot that we can learn from one another in sharing information that we have.
Okay, thank you for that. We'll definitely keep that in mind, and we'll think about, we'll do some, when we do some wrap up, we'll think about maybe we do have sort of a working subgroup on that topic. Nikki, do you have any thoughts or any thoughts or questions at this point before I move on?
No, I'm curious to, hear feedback on some of the other bullet points here as well.
So let's talk forward. So I had a little bit on residual and blue books. The other bullet point I have on this current slide is lease residuals. What might, and I was starting thinking, what might be a target? As I mentioned earlier, I heard the end of a long-term lease, there was a 40% residual for conventional like diesel, but only 15%. I'd be curious if anybody else has sort of real world numbers that they can share, what they, what they're comfortable sharing, like what value do they see in their leases, any strategies to make up that difference. And we heard a little bit about people having some battery comfort with battery life, battery guarantee, things like that. But any thoughts or questions on that? And then after that, have on there the used vehicle vouchers and second life guarantee as well. These things sort of all overlap just a little bit. Olivia?
Yeah, we do have 2 hands raised. So Tony Stinza, I've unmuted your mic. Please give your affiliation.
Hi, I'm with Navistar. I'll try to answer that quick question. Somebody asked, I think Brandon, you asked what's a typical residual for like a diesel vehicle at the end of a lease. There's a few rules of thumb that are kind of thrown around in the industry. One is at the end of a 3-year lease, 50%, at the end of a 4-year lease, 40, at the end of a 5-year lease, 30. So that's kind of a rule of thumb. And one of the issues that you have with EVs though is, the upfront cost is quite a bit more. And so you were giving the example of, well, on a EV, it might be 15% instead of 40%. Well, that 15% might be exactly the same number. It's just 15% of a way larger number. And so I think, but anyway, I'm going to try to answer this as a person who has to put residuals on vehicles. I'm in the used truck organization for Navistar. I think you have to get back to the basic essentials of what like a commercial vehicle is. It's a business tool. It's not a consumer item, and it only has value or utility as a business tool. So why is there value? Why is there a residual value for a ICE powered vehicle? I think the reason is that there's a built up experience and kind of more relative certainty of the useful life in the secondary market. So basically the future use of the vehicle gives rise to the residual values. So then you have to ask yourself, what's different about EVs for the owners of the finance company? And the main thing is uncertainty. I think uncertainty is the key obstacle to setting residual values on EVs. And so now you have to say, well, what are the main things that are uncertain about an EV? And I'm only talking about all this to get down to a solution of what would have to be done. But anyway, first thing is, one uncertainty is the fuel. So ICE vehicles are fueled by petroleum products, and they rely on a distribution network of gas stations and truck stops. If somebody buys a used truck, they know where they're going to get their fuel. That network has grown up over a century. EVs are fueled by charging, and charging isn't readily available right now. Charging for the secondary owner is something that has to be figured out in order for there to be a market for EVs on the secondary market. Somebody mentioned that initial owners are likely to be larger fleets because they have internal capital and self-insurance. I think that's part of it. I think it's also likely that it's larger fleets because they're more apt to have their own charging solutions or be able to contract with somebody and figure that out for a larger number of vehicles. But if you've got a smaller operator, where do they go to get charging? Is there going to be a public solution or something else? Second uncertainty is batteries. The battery technology is changing quickly. There's uncertainty as to what the life of the battery pack is, although I think that's one of the more knowable things. But the bigger uncertainty with batteries is, where are you going to get a battery after the first one? Will your battery still be available? The battery that's compatible with your vehicle, is it going to be available in 5 to 7 years? Should the battery makers be compelled to offer batteries for a minimum number of years after the first sale, so that it's definite and it takes away that uncertainty? And then also, what's the backwards compatibility of new batteries that are being developed? Is that, if that technology is much better, or if it's incompatible with the first vehicle, then you've got kind of another uncertainty, and that's going to impact the residual value. And then the last thing is, we don't know what an EV is going to cost in 5 to 7 years as compared to today. And so are there going to be advances that are going to make today's EVs obsolete? So, you know, if a financial institution is putting a 30% residual on a $200,000 EV today, and that's $60,000. If in 5 to 7 years you'll be able to buy that same truck new for, let's say, $75,000, that's going to impact the residual of that truck that was sold 5 to 7 years ago. So all of this is to say, I think you have to kind of start looking at what are the uncertainties around owning the EV, and then trying to figure out solutions to take away that uncertainty for the financial institutions if you want to get a way to get people to finance these vehicles.
Thank you for that. I'm sort of, yeah, I mean, with terms of like, what is battery technology going to do? I know my Google AI news feed pops up, you know, I get an article every day about some great breakthrough. And then you go and you read it, and it takes a lot of technological reading between the lines to try to figure out what might actually be a big breakthrough, and what is going to be a long time out of some university, some PhD students lab to get into the real world. And it's a challenging topic. I mean, be curious. I mean, there's talk about adding like silicon to batteries. There's a lot of talk of, you know, having solid state separators or different types of separators, solid state. But it's definitely a challenge as sort of any kind of a normal person to see through what all that jargon means to the actual real world, which is an interesting sort of thought process going through my mind. And then how does that relate to new products? And the battery prices, according to Bloomberg Energy, has come down 90% over the last 10 or 12 years. So there's definitely been huge price declines. But lots to think about there, for sure. Tony, thank you for that. Olivia, do we have?
Yes, we have
Let's
three
take
more
another
hands.
couple hands, and we'll run through the last handful of bullet points.
Okay, all right, back to Jamie Levin.
Hey, Brian, those are all really great comments from Navistar. They're all the variables, and he was just dealing with batteries, and we're looking at fuel cells as well, but still some of the same kinds of questions. And I will tell you, I've seen in the negotiation between the lessor and the leasee on what the residual value will be, whether it's an operating lease, or I've seen a desire for a track lease, like a lease purchase agreement, and they are constantly debating what that residual value is on a vehicle that all we know is we have, in our case, a 6-year warranty. That gives some assurances, but we're talking about, truck operators that want 8 to 13 years on their vehicles. And so what's the value going to be? And quite honestly, if the vehicle is reliable enough, it could go well beyond 6 years. But as the previous speaker from Navistar said, the technology is advancing at such a rate that within 6-7 years after this warranty, they could probably buy a brand new vehicle with newer technology, with more durable, reliable performance. So we're just in this period. I mean, everyone keeps bringing up uncertainty, but that is exactly what it is. And so how do you deal with that uncertainty? It means this is the value of the state. This is the value of California, to be able to step in. We offer subsidies initially, and call them incentives, that hopefully will go away with volume. A means to underwrite maybe the insurance costs, not completely. We don't want to subsidize the insurance industry, but maybe there's a middle ground there that gives comfort to the fleet operator. And then lastly, I'll just make this point. When all factors concerned, you're really addressing the financials, and they are big. I think it all has to do with TCO, but TCO is also related to vehicle capability or performance. And if you ask any truck operator, they're going to say, I want this zero-emission vehicle to perform like my diesel vehicle. And if it doesn't, you've put the risk on me as a fleet operator, as to what I can afford to do and what I can compete with. So we talk about range. Range is a factor. Not every job from a fleet operator is the same, maybe short haul. They may be jobbing different projects or different services that have regional hauls. So range becomes a factor. Payload is a huge factor. It's one thing if I'm pulling around corn chips as opposed to heavy items, and the ability to support that. And then the other is the turnaround, the ability to quickly turn my fleet around for refueling or recharging. All those factors have to be looked at seriously, or you're asking the end user to shoulder a much higher risk. And someone said, and I fully agree, that we've got to get buy-in across the spectrum of participants in all of this. If the state wants zero emission, all the parties that play into that. But I will tell you from firsthand experience, some of the biggest shipping companies in the world who profess this green, sustainable footprint, when it comes down to buying the service to move goods, move boxes, they want a competitive price. They don't want to pay a margin. They want a competitive price to what they are currently paying for diesel. And so how do we manage that market force, which is typically intransigent? It doesn't want to vary or deviate from what it is now. And these are our challenges to try and work around if we're going to achieve our 2035, 2045 mission goals.
Perfect. Thank you for that. No, we definitely, the cost is a major consideration. Theoretically, the ACF rule will save money in the long run, but as we pointed out earlier, the capital costs are certainly a challenge, that's for sure. I was going to take, we had 2 hands up, but now we have 4 hands up. I was going to take the 2 more hands and then finish the last bullet points on this slide and then open it up to some more discussion. In terms of time, after this slide, we have 1 more core slide to talk a little bit about where we should be reaching out to the different industries and some of the best places to do that as well. I want to leave at least about 10 minutes or so for that side, and then 5 minutes for wrap up. So Olivia, can we do a couple more hands?
All right, Claire Bachman, I've unmuted your mic.
Hi, can you hear me?
Yep.
Hey, so
well, I can maybe, but
so I have 2 questions for the audience and panelists. First, is it true that the battery residual value is easier to calculate than the vehicle at this point? I guess now, like, you know, traditional ICE vehicles, the customer was just getting the truck, but now they're getting both the truck and fuel source. So how does this impact residual value predictions? And then secondly, if there was more public truck charging infrastructure, would this be a positive signal to insurance and financing providers, ultimately increasing their willingness to finance these newer vehicles?
Perfect. Okay. I wrote them down. So if we don't get an immediate answer, we'll query a little bit more. Thanks, Claire.
All right. So I will move on to 1 more hand. Wei Fan, I've unmuted your mic.
Thank you, Olivia. I'm from RVI Group. We are a specialty insurance company actually focused on residual value insurance. I'd like to respond to what David Sargent mentioned that the ALG J.D. Power, going to spend some time to research on the residual value for EV trucks. And that's great news because for RVI, for 3 decades, we have been insuring personal vehicle residual value risk based on ALG's forecast. And so if J.D. Power and ALG can really, provide, reliable forecast or some kind of with some transparency, we would, if we can get to a level, we feel comfortable, maybe we can use, based off ALG's forecast on the EV trucks, maybe we can provide a certain level of insurance to help the industry to sell EV trucks. And I used to work at J.D. Power, so I think that that will be a great, cooperation between RVI and ALG J.D. Power.
Perfect. Thank you for that. And I know we'll continue our conversations that we've been having with you as well. We look forward to doing that. Okay, Olivia.
Yeah, do you want to keep going or did you want to do?
Yeah, let me go run through the last couple bullet points of things we're thinking about. And I know Bob has some questions that's been on her mind at the Department of Insurance as well. So just in terms, we talked a little bit about use, but one of our thoughts was, do we have some kind of used vehicle voucher to sort of be a second life guarantee? We think about sort of a residual value. Do we have like a residual value insurance product? The other bullet point on here was like the warranty. I mean, we see that, I mean, even in conventional diesel vehicles right now, the warranties are not all that long relative to the number of miles the vehicles can typically do per year. And you definitely see extended warranties are commonly purchased. What else is on here? We have, I thought was very interesting that we would like to talk a little bit about group insurance pooling, potentially like a public option. Some ideas about lease securitization, right? Do we set up like a special purpose vehicle and have similar leases, package those together, purchase some kind of residual value insurance on them, and then market those. As well was one potential idea. It's a little murky as a government agency bureaucrat how we might do that, but I have to remind myself about innovation and figuring out ways to say yes. And then let me just run through the last couple things: how to encourage emerging businesses with flexible operational and ownership models, such as leasebacks or electric vehicle managers and lessors. So are we considering this sort of idea of trucking as a service, right? You pay a flat amount, say per mile, for your truck. That's sort of the for mobility, Watt EVs, and I'm sure I'm forgetting somebody else who will get on my case, so I apologize if I don't have your company off the tip of my tongue. But how do we make sure we include them, and what's that role? And then some of these other things. One of the things we've done is or in progress is suspending the incentive clawback provisions in the HVIP. Is something the state can do. We've been talking about battery health or life. It looks like we're gonna have some conversations about that. And then some more, how do we, do we potentially pay for extended warranty? Bob, would you please run through the couple of questions you have, and that way we'll have everything on the table, and we can spend the next 20 minutes or so hearing people's responses to all these thoughts.
Yeah, hi everyone, Rabab Sharafuddin. I'm with the California Department of Insurance. I'm climate risk specialist in the climate and sustainability branch, and I work with Mike Peterson. And I just had like a question. I know we're focusing on the California market, and but are there other markets in the US dealing with similar insurance and financing issues that would help also an engagement for the department, not only with insurers, but other insurance commissioners as well, through the National Association with Insurance Commissioners? Thank you.
Okay. Yeah, if any of you who are doing national or international work think that we're missing somebody in another state who's doing real innovative work or something we can copy, definitely let us know for sure. Okay, so I think that's sort of all the bullet points we have before the education slide. So I'd love to hear some of your thoughts or feedback, especially on any kind of like pooling or securitization ideas as well.
Hey, Brandon, this is Bruce. And Rabab just brought up a really good point. My internet was starting to go a little bit weird earlier, and I didn't say this. In the slide that I presented earlier with the market and so forth, that is one really critical thing that everybody needs to remember is I mentioned our advanced clean truck regulation, which was the manufacturer's sales requirement. And we're not alone in that. There are 8 other states that actually have adopted that. So it is legally binding in those states, which will obviously increase the market need throughout the US. And there's about 17 states, I believe, including Quebec and DC, that have a memorandum of understanding to accelerate these markets in their states. So, again, Rabab, thank you. That was a really, really good question. It's not just a need here in California. It is becoming a national need as these vehicles start to permeate those markets.
Perfect, thank you for that. All right, Olivia, do we have some more hands?
Okay, so just a reminder, please state your name and your affiliation. Stephanie McGreevy, I've unmuted your mic.
Thank you. Yes, I appreciate you having this seminar. My name is Stephanie McGreevy. I'm with Open Energy Alliance. We perform zero-emission fleet conversion feasibility analysis for fleets. And I've worked in the CNG market prior to the zero-emission market. And I know we did a lot of fueling as a service, as you'd mentioned earlier, trucking as a service. Taking the capital expenditure and putting it into the operational cost column, which was a huge savings for fleets. And so I'm just curious to know what the pushback is on that. Are you still having issues because there's no way to really figure out residual values, or because back then they didn't have that data either? And so I'm just curious to know what the difference is.
Good question. I don't have a really quick answer. I know it's and Nikki, feel free to chime in, but my thought is the way the main incentive programs have been designed for a long time, they've been definitely far more aligned with just straight purchasing. Not that they've necessarily not been allowed, but it's been sort of the easier process. If we have anybody on the call still from one of these companies, I think would be great to hear your perspective and respond to that a little bit. But I think for me, part of it, bringing it up, is to make sure we're not forgetting anything in our work, because it is being able to capture the much lower fuel costs, right? The electricity over diesel in most situations. So you're not charging in the absolute peak of the day. And being able to capture any of like the low carbon fuel standard credits as well. There should be significant cost savings overall if you can get into the vehicle.
All right. Next, hand we have raised is Richard Hall. I've unmuted your mic.
Hi, this is Richard Hall. I'm with Zappyride. As many may know, Zappyride is part of JD Power now. We were acquired in January. And in fact, I love the fact Brandon just brought up LCFS. So I'll wind it into this comment. I think it was very good that one of the commenters talked upon the risk that fleet operators have to take when they basically bet the farm on EVs. And I think Dave Sargent already spoke, and we have a team within our company at ALG, which is a division of JD Power, working on residuals. What we are trying to do is build out constantly improved TCO tools. And I think things that are being talked about now, I would really open it up to people to get in touch with us, Richard Hall at Zappyride or JD Power, to give us more insights, because we want to improve and make these tools provide the confidence to the fleet buyers. And obviously the questions they have, the commenter that spoke about TCOs before brought up a very, very good point, which is that for heavy duty vehicles, there's not a lot of information about the impact of climate, payload, speed on range and fuel costs. We're definitely interested in talking to OEMs to bring that kind of information into these TCO tools to improve it. LCFS, actually, we've got pretty well covered. We actually take the latest LCFS, the latest cap and trade price, and we fold that in. And based on your fleet and the kilowatt hours that you're using, we then spit out the actual LCFS revenues that you should get, be it that you may engage in custom companies to apply for those revenue credits for you. On the financing, I think that's a really important thing as well. Again, we're looking to improve, and we're building into our tools financing and leasing into the TCO tool, because that has a significant impact, as well as the resale price and the residual factor that the financing company respects is going to hold. So we're also looking for input there to basically make and improve the tools. So I don't necessarily have an answer, but what we offer, and we're interested in, is talking to people who are on the line who basically can help us improve the accuracy of those tools. And yes, we're on the case, we're listening about residuals. Yes, battery health is a big deal at JD Power, and David Sargent, who spoke, is very much focused on that topic. Thank you.
Yeah, I think that he speaks a little bit to Claire, and Claire Bachman we had on, she's also part of our team helping out on the CalSTART side of things, how that battery, sort of how we calculate those battery residual values, and how can that get translated into some assurance on the residual value of the vehicle. It's sort of an interesting concept as well.
All right, that's the last of our hands, Brendan.
Okay, I see no more hands up. It's 4:45. Any final thoughts? I've not going to say this. Howard, we've not heard from you for a while. I thought we might hear from you again. So if you want to add anything in, or I know I see Mike Tunnel on here too. If you have any thoughts on the manufacturer truck side of things, feel free to put your hand up. But otherwise, let me go ahead and skip a slide forward.
We did have a hand get raised. Irvi would like to speak again. Do you want to?
Yeah,
Take that? Okay. Herbie, you unmuted your mic.
Hey there. I think one of the examples of a program that really worked in the past was when the CEC was investing in school buses and wanted to save a lot of fleets the time of having to run their own solicitation, where they did that two-part contract where you could then buy the school bus at a set price. I think CARB has a unique opportunity where you could similarly run a procurement and say, hey, here's all the vehicles on HVIP. Do you want to bid at a set insurance price, where you could then buy that insurance rate if you buy any vehicle off of the HVIP listing? Because I think that ability to transparently know what price you're going to get into and what the min spec is, similar to HVIP vehicles all have a min spec and certification, could be very valuable. And you could do it in a similar structure that people are familiar with, where by reducing the risk at the point of vehicle discovery, you create both sort of a trusted network, as opposed to if the exact same information existed from a salesperson, because they're trying to sell you something, you're not going to trust it as much. And I think that's a really unique add value that CARB could offer that no other agency could.
Perfect. Thank you for that. I think that's very insightful as well. I have not really thought about, know we've done the bulk purchasing before with the school buses. But it's definitely an option we'll look at. Some of that, that's where we're sort of thinking a little bit about like public pooling and sort of public options and having sort of groups of things. Okay, let me run through this slide and then we'll get any final comments. Bruce, are you good enough to run through this, or do you want me to do it?
If everybody can hear me fine, I'll just stay off camera on my little phone here.
Yeah, we can hear you.
Good, perfect, thank you. You know, and we've talked, I think, about a lot of information today, and a lot of that comes down to educating not only us, which you have today, which is great, but us then educating industry, educating fleets, and so forth. And what we're really looking at here is we have talked to folks, we've talked to lenders, we've talked to some in the insurance industry, and when we ask them, you know, would it be helpful if we would provide you, the lenders, the insurers, with information regarding zero-emission vehicles, regarding the need for zero-emission vehicles? I mean, not just, as I mentioned a moment ago, not just California, but this really growing national effort to bring zero-emission vehicles, medium and heavy-duty zero-emission vehicles into states and into fleets. Would that help you? Would that provide you some basis to be able to go back to, you know, your boards of directors and say, look, it's not just someone that wants a toy out there. There is not only a growing need, but a legally mandated growing need. So we really want to work with the industries to do just that, to provide education. In fact, we're working on some, you know, real basic tools right now, just to give you the facts. Like when we talked about the market-based or the ZEV market earlier that was being driven by our rules, just to provide some facts. Any other information we can provide, you know, we heard from Nicola earlier that they have a lot of data, others have a lot of data that maybe, you know, we can incorporate into this package of information that will help insurers and finance institutions really understand, you know, what is really out there, what the facts are out there. So what we're turning to you today, in addition to all the other great information you've provided, is how do we get that information out? You know, do we work with what are some of the various associations, conferences? I don't really know any lender associations and conferences, although I know CalSTART does. We have the insurance commissioner on, and they obviously have some insights into insurers conferences and so forth. So probably attend a lot of those. But what do you guys see as really good ways to get this out? Newsletters, blogs. I mean, whatever. We're open to, you know, getting it out however you think is best. And does that sound like the kind of information that we need to get out? So having said that, I think I will turn it back over to Brandon.
Yeah, so sort of our broad comment is where where should we meet you and talk to you? I think for me, are there specific insurance or finance conferences that we, CARB or CalSTART, should really make an effort to get to, get in front of you, really say, hey, look, these vehicles are on the way. The rules are in place. The vehicles are on the way. It's worthwhile spending your time to get in that part of the business. Not seeing anybody hands. Surely someone must have a favorite blog or social media or in conference that they like to attend or think that is useful that I do not know about.
I would say even what is some information that, maybe I didn't mention that would be really useful to provide to insurers, to financial organizations and so forth. Any thoughts on that?
Irvi, I see your hand is raised. I'm not sure if that was from last time, but I've unmuted your mic if you wanted to chime in.
Sorry, I forgot to put my hand back down, but I would say in terms of the best source of information when it comes to some of these pain points, it's actually stupidly old school. It's listen to people complain at the conferences about what's not working, not at the actual panels, but at the bar around the conference, because by the time they put it into a newsletter, blog, etc., it's been vetted by PR, it's been vetted by marketing. Everything on stage is vetted. And if you want to know how deep a problem goes, you can't have the polished gem of what is ready to market. And I think that's one of those challenges of, having off the record meetings where people feel it's safe to air their dirty laundry is the only way you're going to get data that will actually be relevant. Because, for example, if you went and you said, let's look at Ralph's fleet database, those vehicles are commercially available for sale and got vetted by legal, compliance, warranty before they were ever sent to that lab for analysis. And I think that's just, you're looking at data that is cleaner than the industry is.
Yeah, conferences are a very interesting resource, and I think everybody on this panel is well aware of the conferences that are focused on facing fleets or EV or industry. However, I got a really excellent recommendation from our friends at PACCAR who said that they attend annual conferences for commercial vehicle financing or the conferences for, actuarials. So that there were these conferences that were, very industry specific, that there is where we should be carrying this message of the fact that the California market for zero-emission commercial vehicles is quite large and growing, and that they should be developing products for it. So I was really, really hoping that before folks logged off this call today, everybody would chime in with at least one association, conference, or event where we can go to really carry this message.
I assume you're familiar with MEMA, the Maintenance Engineer Management Association. But the reason why maintenance engineers are a really great place for information is you're going to see them having to deal with the budget items, the actual repairs, the ordering, the supply chain. And so if you can figure out what's been working with them, that will often tell you what works with the rest of the organization, because anytime it doesn't work with maintenance, the vehicle is down.
Great, thank you. I was not aware. I appreciate that. I see Howard's hand up.
Howard, I've unmuted your mic.
Thank you. Just from an equipment leasing association standpoint, the large equipment leasing and finance association is called ELFA, Equipment Lease Finance Association. It's a gigantic organization, and there are numerous conferences that are going on. So to increase awareness about the market opportunity to the finance company community, that's as good a place as any. So I wanted to mention that, and being more specific about which conferences, I'd be happy to chat with anybody about. I'm on some of their councils. I guess I had a question as well. Kind of where do we go from here? Where is the team trying to come up with the pilot program? Where are you specifically in your process? Because I feel like there's a bit of a need for, if nothing else, maybe a straw man to be put out to say all these things that we've contemplated. You know, here's kind of a current view of how we think we can offer something that is going to drive acquisition and start the ball rolling. Because I have many clients in that small to mid-sized fleet market in Class 8 drayage focus, that I think the application for Class 8 electric tractors or zero-emission tractors is going to be. But right now, we just keep talking to them about concepts. And I feel like this, you know, we got to not necessarily say, yeah, we're making a final decision, but kind of put a framework out to say, this is what we're thinking about, and get some very specific customer feedback. I think that might be a helpful step. Thank you.
Perfect. Thank you. Let me use it as a segue to the sort of last slide. And on this here, I have in here CARB funding plan process for 2023. I mentioned this very briefly earlier, but one of our thoughts is we want to potentially put together a menu of options. So there's choices depending on, you know, different situations, and then we can also see, okay, which ones work and which ones don't, and pick ones that are working and potentially enhance them. But part of that funding plan process, there was the first, I believe it's the first week of June is the kickoff meetings with the follow-up August, I want to say 31st, with potential board approval in November. Anything that we generally want to fund that's new and not already approved, we need to have in the funding plan, at least a rough placeholder that we can further fully develop the program after it's approved by the CARB board. So that's my first thought. As well, Nikki, do you have some thoughts on our? I think my other thought was, hey, do we want to have separate insurance and finance meetings? And I think we need to do a huddle about what we've heard today as well, and come up with a plan of what do we want to sort of propose and what we think might work and where we want to put it into. Nikki, does that sound like, are you on the same page since we work as a team on all this?
Yes, I certainly am. I would love to get more information via email or hold more meetings, but the plan is to make a recommendation in the next few weeks here. And then once that recommendation is approved in the fall, we would have the opportunity to further develop the program with potential rollout at like early next year. I think that's sort of the timeline we're working on. Now, this is not about the truck loan program, though. If Howard was asking specifically about the truck loan program, that's an Eric question. But I also saw Alexandria's hand up when we were asking about places to go, and I don't want to miss it if there was a good recommendation there. So before Alexandria drops off, I would like to address her hand.
Hi, I'm Alex Eschenbrenner. I'm the regional finance manager for Tech Equipment. One of the things that we do notice is, you know, obviously we're on the Volvo product, and we're talking with some of the other manufacturers. There may be a disconnect with CARB and the actual manufacturers on getting on board with whatever the new CalCap program is going to be for the electric side. So that is something that may be on the manufacturing side to get them a little bit more on board and help. Because other than that, Crossroads is going to do a fantastic job of getting a lot of business from everybody because they are aggressive on that side of it. So that is definitely a recommendation. And anybody else that was on that list, looking at like the BMOs of the world and some of these other banks that are listed on the flyer that you guys posted on the financing and leasing companies, I was kind of shocked to actually see quite a few of those names because a lot of them aren't actually the best partners with us on a lot of it. So maybe retouching and kind of just reaching out to them and really refocusing on what their partnership is with this program and how they can be of assistance to the dealers and the manufacturers that are putting this product out there, that are leading the way on the California side, that are going to really kind of set the map for everybody else.
Thank you.
All right, it is 5:01. So here, this last slide, I have some of our direct contacts. Since this is not like a big rulemaking, we don't have a separate email set up. But if you want to follow up with something you've heard today, or maybe something is a little bit too business confidential or sensitive, feel free to reach out to me or Bruce, who's my manager, or Nikki, or Steve. Here are our email addresses to do that as well. And then we'll do a huddle, and we'll come up with sort of some next steps and timings on what we think are some proposals might look like, and how we can try to get those funded and get some feedback from everyone as well. All right, any final thoughts? I would just say thank you to all of you who've come and joined us today. We appreciate your time and your effort, and we're definitely here to do our very best. That's all of us can ever do as well. So thank you for joining us, and we'll talk to you hopefully in the next couple of months. Thank you.
Thanks, everyone.